Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Is TRID slowing you down? Not if you're closing with UWM. While other lenders are struggling, we're closing most TRID loans in 15 days or less, thanks to easy-to-use tools like UClose and Ease, and direct communication from submission to close. Get United at UWM.com.
Welcome to another edition of Master the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network, brought to you by United Wholesale Mortgage. So many tools to help you in your business. Check it out. Now, last week we did see some interesting movement in the markets. We were calling for a reversal, and that's exactly what we got. We got the stock market bottoming out. We said 1812. It was roughly 1811, almost a direct hit on where stock prices went on the S&P, and then bounced and moved higher. We did say look for that 160 level on the 10-year. It very briefly dipped below it to about 155, but that 160 level was a target. It was hit, and then things did reverse. We saw rates move a little bit higher from there. But towards the end of the week, some things that were very interesting occurred. Stocks, after 3 big up days to start the week, started to stall and started to move a little bit lower, right at a resistance level that we've been talking about before, around that 1930, 1935 level on the S&P. Where do we go now? Well, here's the thing. We did get some inflation numbers, and that's the CPI report, Consumer Price Index, and it showed some of the biggest inflation gains in over 4 years. So how does this happen? One of the things that occurred was we got the headline number. It includes energy prices, and that jumped by one of the biggest gains we'd seen in a very long time to 1.4%. Now, that's not a big jump, but still, it's a relatively large move because it virtually doubled in just 1 month, and this is on a year-over-year basis. So how's that happen? Well, here's the thing. It looks at the most recent year. So when we go back now, a little over a year ago, oil prices really started declining. They went from roughly $100 a barrel on WTI, or West Texas Intermediate oil per barrel, down to about 60. So now, even though oil prices are very low, they're roughly $30 a barrel, the relative change goes from, instead of it being $100 is where the measuring stick was, to now $30. It is now looking at $60, because that's where it declined to about a year ago to today's $30. So yes, it's keeping inflation depressed, but not as much as it was. So now we're seeing inflation start to creep up. Now, when you strip out food and energy, we also got a very big number on a relative basis. Certainly not a big number, in itself, 2.2%. But that's above the Fed's target of 2. And in addition, it's the biggest number we've seen in a very long time, 4 years plus. So when we see numbers like this, why are bond prices not responding worse? And we know inflation drives interest rates, and we know inflation is a big factor that will determine the direction of where mortgage rates will go. So why, when we get some inflationary news, did mortgage bonds not respond worse? Well, here's the reason. Is because a lot of this is, imagine a seesaw, stocks on one side, bonds on the other. If you're going to put your money in bonds, a lot of times you take it out of stocks. If you're going to put money in stocks, you take it out of bonds if you're a money manager. So what happens here is that the stock market does not like this inflation news. Why? Well, because the Fed is now in a position where we have recently heard them say, hey, look, we know we were talking about 4 rate hikes in 2016, but there are global pressures. Other nations are reducing rates, more QE. The U.S. stock market's decline. Manufacturing is kind of in a depression. So they seem to be at least backing off of that hike stance. Well, this inflation news kind of puts the Fed in a position where they have to start considering it. Because here's the thing. The Fed has what you call a dual mandate. They want employment to be at full employment, and look, with unemployment numbers at 4.9% and some pretty reasonably good job gains. Now, we could debate this, because we could say, okay, look, we've seen dollars hourly earnings go up, but you know what? In December, 2 states, and in January, 12 states raised their minimum wage. Walmart raised its minimum wage, and they employ 1.3 million people. So when you look at just the force of these minimum wages going up, of course hourly earnings are going to go up, but it's not based on merit. It's not based on a tight labor market where you have to pony up for employees. So it's kind of a fictitious number in seeing hourly earnings jump that way. In addition to that, when we take a look at the the gains that we're seeing, a lot of the gains aren't in the higher dollar earning positions. So yeah, the unemployment numbers are good. Yes, the job gains, you have to say they're pretty good, but they're not super robust. The Fed's had cover to say inflation numbers have been below expectations, but now they're starting to tick up. Now the Fed still has cover because while CPI is the number that we got last week, and CPI, in my opinion, far more valuable because it incorporates rents and owner's equivalent rents and out-of-pocket medical expenses, the real costs that we all have to consider, right? PCE, which is the Fed's favored measure gauge of inflation, does not account for that. So, how the Fed can justify this with a straight face and say they prefer PCE, it's beyond crazy, okay? But that's the world of the Fed. They're going to pretty much do what they want, say what they want, and hide behind whatever they want. Now, look, team, when you take a look at rents going up, and the reports are in the CPI 3.7% per year, but other reports say as high as 4.5% a year, so let's call it 4% a year. That's big, and it's something you should be aware of, because when you do the math and you compound 4% on a current rent, renting quickly gets more expensive than owning over a short period of time. And right in MBS Highway, we've got so many great buy versus rent tools that exactly portray that and show you that difference. Really helps your clients and really helps your real estate partners understand this, and helps them metaphorically hold their customer's hand and do the right thing and purchase a home instead of renting. All right, so because we have this situation where we see inflation is starting to tick up, if the Fed is now maybe pressure, it's not going to happen in March, they're not going to hike in March, but if maybe at the next meeting they start to consider a rate hike, stocks don't like that. So that's why money currently coming out of the stock market, maybe it's going to retest those lows. Maybe that money goes back into the bond market, even in the face of some inflationary news. And just because of that cash flow going into bonds, we're seeing bonds pretty much hold their own. Now, they are in a big trading range, as is the 10-year Treasury, and as is the S&P 500. So we could see some whipsaws here. It could be a very volatile time. Sign up for free for MBS Highway on a trial, and we'll walk you through it. If you already took your trial, go ahead and sign up, man. This is a big money business. Your clients need you and depend on you. Would you go see a physician who wouldn't invest in themselves a few pennies per day to be better and give better advice? I bet you wouldn't send anybody to that physician. Why should somebody go to you unless you're ready to invest in yourself? All right, hope you guys have a great day. Talk to you next week. Bye.
Today's Master the Markets was brought to you by United Wholesale Mortgage.
At UWM, our AEs receive over 500 hours of training each year to keep you current with the industry. We give you direct access to your own team of underwriters who return your calls in 3 hours or less. And we provide exclusive products and tools that give your business a competitive edge. In fact, everything we do at UWM is dedicated to championing your success, which is why more brokers choose UWM than any other lender. World-class service, exclusive products, groundbreaking tools, and you. Get united with us at UWM.com.
This is Mortgage News Network.